Good morning and welcome to the last instalment of the year of Crystal's complex cases. And what a year it's been. We've seen a lot of changes in the market, a lot of turbulence. Base rate has just gone up and gone up and gone up, but started to stabilize. But the one thing that hasn't changed in the marketplace is brokers' resilience. It's been a tough time, but we've all got through. We've all got through this together. The market's changed and it is going to continue to change and shift more towards specialist finance. I think now more than ever, we need each other. We need a great network around us and great support and education like these webinars. So thank you very much, everybody, for joining. Thank you very much for our regular attendees, and we hope today is a great session. As always, it's free format. As much as we've got a theme for today, we like to do free flow. We like to fire as many questions as possible at the tax wizard. So without further ado, let's get stuck into things. Joining me today, we've got the guy who doesn't need any introduction. He's the show pony of this. Unfortunately, it's not Roger. It's John McCaffrey from Alexander & Co. Morning, John. How are you doing?
I'm well, fella, and you?
Yeah, good. Thank you. Good. Looking forward to Christmas shutdown. Not long ago.
Yeah.
Not long ago. And then the other guy, which some people may or may not have heard about, he has been in the industry since before specialist finance began. We've got Roger Morris from Tandem. How are you doing, Dad?
I'm doing really well, Dan. I actually think what you've put on this year and the knowledge and the education Crystal has delivered in all sorts of sport, particularly these webinars, I really want to compliment you for that. And I think today's session will pique them all because we are lucky to have the tax wizard on, who is also has an in-depth knowledge on accounts and accountancy. And I think the two of us now are going to grill John, because if there's one subject, I think, Dan, that really resonates with you and me the most when speaking to brokers is that subject on affordability, whether it be for buy-to-let or residential. With buy-to-let, it's the ICR calculations at the rates given, and it's equally impacted on residential. So I think today, Dan, if we maybe take turns, if John's okay, where we delve into how to extract the right income for affordability, specifically for residential mortgages. And then maybe if I could ask you some questions as well on affordability on buy-to-let, Dan, as well. So I'll leave it to you to kick off the first question to John, but I definitely think we really need to be able to deliver some real solid information to everybody listening in.
Yeah, no, 100%. And the next hour is going to be vital and very useful for everybody involved in this session, because it will touch your cases in some way, shape or form. We know that from a survey that we've done recently, the biggest things that are impacting cases is one, adverse credit, which we can absolutely touch on, but two, it's all about income and getting the clients the right income to get them the level of mortgage borrowing that they need. Obviously, next year we've got 1.4 million fixed rates maturing in the residential space, which is going to have a massive impact on clients' disposable income, so to speak. It will be challenging for a lot of people, but ultimately this year has been a tale of PTs, hasn't it? A lot of brokers have spent a lot of time doing product transfers, not only once, maybe 3, 4, 5 times. And because of that, their own personal income has dropped to levels below what they've earned for many, many years. But ultimately, the average mortgage acceptance rate, again, is at almost an all-time low, because we can't get the income that we need to get them to them borrowing levels that they require. So that's where the tax wizard's going to come in, because he's going to, as you say, be able to tell us and show us how we can get the most from accounts. So yeah, John, let's get straight in. Anyone that's got any questions, again, it is free format, so please do ask away. And we'll answer whatever questions, whether it's in relation to extracting income or anything else tax related that you want to know about. Please do fire away. And if they're tricky and complex, brilliant, because we do like to challenge John. We really do. So John, biggest question for us is, from an income point of view, what, I wouldn't say your top tips, but what would you say brokers and individuals would need to know around the income piece and what to look for in accounts to get the most from it?
Okay, so I'll give you a bit of an overview. Just as a bit of background, whilst doing tax, I've trained as a chartered accountant. So I've got the full accountancy background going on. Clients or customers with properties probably fall into one of 3, maybe 4 categories. Okay. They will either be individuals who are holding property, and we call them sole traders. They may be in partnership, which could be a common partnership, or it could be an LLP. Might be a trust structure, or it could be a limited company. And in terms of the filing and accounting requirements, from my point of view, accountant's point of view, and tax point of view, they're all very, very different. And what we find with clients, we deal with entrepreneurs, and the thing with entrepreneurs is actually they may make a large slug of money, but not necessarily have what would appear to be a decent level of income coming through. Okay. And when dealing with brokers and mortgage providers, there's a little bit of computer says no, because when you show them the tax returns, it may show that actually, you know, they've got a very low salary, or they haven't taken a particular level of dividends. Yeah. And it's kind of like, well, your income isn't sufficient, therefore, to be able to afford the lending. And if you look behind it and looked into the records of these people, you might actually find that these people are very decently wealthy with sufficient security and liquid assets in order to be able to more than afford the lending, right? And it's just a question of digging behind what's going on. So I guess if from a borrower's point of view, if they want to make their life easy, what you want to show is a tax return that has a sufficient level of income on it, whether it be through rental income, through a salary, through some form of dividend income. The flip side to that is if you are showing that income, you're paying tax on it, right?
Yeah.
And that may not be in the best interest of that particular individual, right? So we've got a bit of a clash between our two worlds here. Okay. So to run through each of those, basically a sole trader would do a tax return, and a tax return, SA 302, will show what income that individual has in that particular year. Okay. That will be from all sources. It will be interest, it will be rental income, it will be dividend income. And as I said, there may not be much of it depending on the circumstances. Okay. What it doesn't show is a person's assets and liabilities, right? Mm-hmm. So as a broker, if you're looking to finance a sole trader who you know to be decently wealthy with a decent bank of properties or something like that, you want to get an assessment of what those individuals' assets and liabilities are and how liquid they are, how easily convertible into cash. Yeah. So that would require you as a broker to go digging. The SA 302 doesn't show you a great deal. In terms of a sole trader, you don't actually need to do any more than a very basic set of accounts, which is kind of like income, expenses, giving you a profit. It doesn't show you the assets and liabilities you hold. So my top tip in terms of a sole trader would actually to be produce a set of accounts showing your net worth signed off by an accountant, and you can add that, and the more specialist lenders out there would be happy to see, because they can see there is something on there signed off by an accountant stating that this person has sufficient wealth to be able to afford the borrowing.
Perfect. Okay. Just to pause you there. So that's brilliant from a tax point of view. Rog, from a lender point of view, how would that sit with Tandem and the wider market?
Oh, Dan, honestly, I'm really pleased you jumped in there, because I think the question you've asked is really relevant. So a lot of lenders will actually like to see a set of accounts. If you take Tandem, we want an accountant certificate. So Dan, if you were the applicant, you've done your SA 302, we want an accountant certificate to be able to take your application forward. John, if Dan's done his SA 302, I now need an accountant certificate. Dan could come to you. You would have to take the time to go through the formal process of producing the accounts to be able to issue a certificate. And just as a timeline, if Dan was able to give you all the information roughly in one go, how, depending on the time of year, you can maybe get that through in 3 or 4 weeks?
In 3 or 4 weeks, depending on time of the year. If depending on close, it's generally quarter end, so that's when a lot of people run their accounts to. You're looking a good couple of months in those circumstances.
Yeah, and so my point would be, Dan, is where we are taking self-employed, that accountant certificate and having that 1 year's accounts is huge. And the biggest tip I would give any mortgage advisor out there is get the accountant, if you can, to do a covering letter explaining what income should be used for mortgage purposes. And the reason for that is the high street banks no longer have the capability of reading a set of accounts. Dan, you know this by the amount of work you do with the self-employed at Crystal. And if you get an accountant, an underwriter who is relatively new, looking at a set of accounts that will be going, don't really understand it. Now, chartered accountant's word is the equivalent to God in the sense of what they say is a true and honest statement. So if you can get a covering email saying, please find the set of accounts for Dan Morris, with it being a set of accounts, you would normally, in theory, have the previous trading year. Again, it just depends on what's been asked to be done. But it would give that, if you did get that covering email, it would set out what the income is and that overview and explanation, particularly if there's been a reduction in this year to last year's net profits, Dan, because they've invested or expenditure. So I would always advocate that if the client has an accountant and a good relationship with the accountant, that summary email, if the accountant could find to do it, is worth its weight in gold.
Oh, 100%. No, I agree with that. And you made some valid points there, because yes, the SA 302, etc. paints a picture, but it doesn't tell a story. And what specialist lenders are interested in, it's about how well that story is told and if it makes sense, because it all comes down to common sense within the specialist market, doesn't it? It's not a tick box exercise. From my days as one of the juggernauts on the high street, it was a tick box. And even at underwriting, when it went off site, it was still a bigger tick box. Whereas Tandem's approach and all these other specialist residential lenders out there, it's all about, does it make sense, and can we tell a story to put the client in that position? Because that 1-2 pager, brilliant for headline figures, but as John said, there's more that we need to be delving in behind it to actually understand the client's financial position. Because these business owners, and the reason why people go self-employed, it's ultimately tax, isn't it? It's from a tax point of view, a better position, and they're going to put themselves in the best position possible to pay as little tax as possible. But it is a bit of a hindrance at times when it comes to things like lending, to actually evidence it and be able to showcase their net worth. So no, that's a great tip, that, John. And obviously it shows how long it could potentially take to get them mortgage ready from an accounting certificate point of view.
Yeah.
So yeah, brilliant tips and brilliant points there, guys. And yeah, John, continue with what you were saying.
No worries. So in the same thing there, in terms of a trust and the old type partnership, the 1890 partnership, they are exactly the same as a sole trader. You get profit and loss, income and expense, right? But you don't see the value of any underlying assets. So again, the tip on those is actually to get a proper set of accounts done, showing the assets and the full position. Okay. So then you move on to your other type of lender, right? And this may be your kind of lender with a limited company. Okay. So you might have either the limited company looking to borrow, or an LLP looking to borrow, or the shareholder partner in those entities looking to borrow. So I've got an SA 302 for a shareholder showing a poor position, say, right? But he's got a company that's got a really healthy balance sheet, right? So if we're talking about accounts, and we're talking about what to look for in accounts, I think a bit of an overview on how accounts are structured is probably worthwhile. Okay. So a set of accounts is generally run for a period of time, and that period of time is usually a year. Okay. And it's got 2 statements in it, one of which is the profit and loss account, and the other one is the balance sheet, right? The profit and loss account shows the income and expenses of that business for the whole of that period. Yeah. So it's all your turnover, all your costs, all your interest, all that kind of thing coming down to a profit. Okay. If it's a limited company set of accounts, it will usually show a comparison to the previous year. And these have to be filed on Companies House, which is easily accessible by anybody just Googling Companies House Beta. You can look up the name and it will show you several years of P&L and balance sheet and accounts. So you can get a full picture of what's gone on. Okay. The balance sheet is a statement of the assets and the liabilities, or what they own and what they owe out at the end of the period, not throughout the period, at the end of the period. So you know at that particular point in time, this is what they own, this is what they owe out. Okay. It's split into two parts, the balance sheet, and it's quite important. So the top bit is the assets. That is the value of the properties they own, the debts they are owed, may not have recovered yet, the cash they have, and the bottom bit is the liabilities. So the creditors, the amounts of money they owe out, the mortgages, the any other debts they owe to electricity suppliers, that kind of thing, right? And that will give you what's known as a net asset position, okay? And the more positive the net asset position is, the stronger that company is, the balance sheet is, right? Now, depending on the size of the company, and this is again probably where a top tip to get yourself mortgage ready is, you only have to disclose certain information to Companies House, okay? So some of these companies will only have a reduced balance sheet, no profit and loss account. And again, unless you're an accountant, looking at a balance sheet, you might not fully understand what's going on. You might look at a net asset figure and go, well, that's, a couple $100,000. But it might turn out actually, if you look further up, they've got £1 million in cash on the balance sheet. That makes this all affordable. The properties are at the top and haven't been revalued, so they're not showing the full value of the properties, right? So two things I would do if you want to get yourself mortgage ready is, one, put your proper value of your properties on the accounts. Two, when you're providing accounts to a lender, make sure you've got the full picture. Make sure you've got both a profit and loss account and a balance sheet that they can look at to see, right, I can see they're generating positive income on a regular basis, and I can see that the asset position is strong, in that they've got a decent amount of cash, good value properties, limited debt against those properties, yeah? And that then puts them, now let's say we've got this, and he's got positive net assets of £1 million, right? But he doesn't need the money because he sold a property. So his SA 302 showed him having like a 10 grand basic salary and no dividends. On the basis of the SA 302 alone, you wouldn't have looked at this guy, you wouldn't have accepted the mortgage lending. But if you look at the accounts and the fact he's got this £1 million available to him and he could receive dividends, it's a completely different picture.
100%. 100%. No, there is, and there's lenders out there as well, which a lot of people aren't aware of, which they'll do their income plus their share of net profit, for example. So again, it comes back to painting the picture but not telling the story. So having both documents or an accounting certificate, etc., covering letter, then it's going to help them and put them in a better position. But do you know what? Some people might again look at, right, okay, so this is what you wanted to buy. You want to buy £1 million house, but you're only showcasing 50 grand worth of income on your SA 302. Can't do it, sorry. Next, move on. Well, actually, if we'd have asked a deeper question and dug down a little bit deeper, you might see that in the background, there's a load of profit in the company which hasn't been taken out for tax purposes because the accountant's not advised it. Because it's like a lot of people, certainly entrepreneurs, will take out what they want, what they need as a bare minimum because they don't want to pay the tax in it, and it's getting reinvested for business purposes. So it's just about asking them additional questions, isn't it?
Yeah, absolutely.
Perfect.
And Dan, is it worth just asking as a question with what John's covered with the LLP? Because say, for instance, you come across a solicitor, no LLPs aren't as common as there was a kind of there was a lot of them being set up and then not so many now. But if an advisor, we do get advisors. I had one this morning was saying client works for an LLP. How do I calculate the accounts? Because a lender had said we need to get the full accounts and bank statements for the LLP, and I'm going, no, you don't need to do that. In effect, you're self-employed, and it's your shares and your income that you've extracted from your employment with the LLP. Is the simplest way I was trying to explain it. But John, do you want to explain that?
Yeah, no worries. So limited liability partnership, LLP, right? LLPs are required to file accounts at Companies House. So you will find a full statement, or you should see a full statement of profit and loss account and a balance sheet for an LLP, right? Now, the difference between an LLP and a company is that the partners or members in an LLP are taxed on the income as it arises. It's transparent, right? So what happens with an LLP is the LLP has to do a full set of accounts, but with regard to the individual, they are only entitled to their share of the LLP assets, liabilities, and profits. Okay. So what you need to do as a broker is work out what their entitlement is. So you're right. If you took, I'd say in my game, a PwC, right? The largest accountancy firm in the world, right? 2,000 partners in the UK. Their LLP has 2,000 partners, and looking at PwC's accounts is pointless, because actually it's more or less irrelevant to your single partner who's looking to borrow. Okay. What you need to see is their share of the income. Okay. So the LLP will do a partnership return, tax return. It will allocate the partners their share of the profits, income and liabilities, right? And that partnership share will go on the individual's SA 302. And in these circumstances, the SA 302 for that individual partner is more relevant because it reflects their personal income worth in that year. So when you're looking at a partner, that's probably a starting point, yeah? Because they're only ever entitled to that share of profit, okay? Yeah, that's pretty much it, to be honest. Looking at the SA 302 for the partner rather than the whole set of accounts. Now, if you've got a partnership with two partners, or an LLP with two partners, right, then the accounts become more relevant because the guys are entitled to 50% of the assets and liabilities each.
Right. Okay, perfect. No, some valid points on there. Roger, did you have anything else to add on the LLP before we move on?
Let's just reiterate the question out, guys. If any of you got any questions for John, just put them in the chat facility. Even if you think it's such a basic question, a lot of the times the most basic ones are missed, and it is literally this is a chance to ask the question. And to reiterate the one point, just because somebody has passed their accounts qualification, it's a separate qualification for being a tax advisor. John is one of those very few who've actually got both, and the two really should never really be mixed up. So John, when you're looking now from an accounts point of view with your team, and you have a big team in Manchester, where there will be challenges from lenders on accounts or wanting further information. It could be just a clarity of why there was a profit, a reduction in income this year, and it can be explained. It could be many different things. Is there a recurring theme that you're seeing in the last 6 months on any questions that the accounts team may be having from mortgage advisors, or is it just the general run that you've seen?
It's a misunderstanding of the worth of a person. That's the one we come across a lot of the time. Their SA 302 does not reflect the worth of that person, and it won't. It reflects if for example, you have as an individual, you've sold a business, you've got a load of money, you've put it into some property and investment portfolio, right? your income is minimal, okay? Because you don't need it. So what you're doing is you're trying to preserve your capital. Yeah. And they get knocked back on a regular basis. And because this happens quite a lot, their salary isn't high enough. And it's kind of like we get questions about that a lot. It's like, you advised us not to take the salary. It's like, well, you'd be paying tax on it. So in those circumstances, it's very much looking down to what assets do these people have? What do they own? Have they got access? And it's going just that little bit further beyond into looking at these companies and looking at their assets and the value they have, or the wealth they have access to, rather than the small amount of income they've shown on their tax return, because they don't need to generate the income.
No, exactly that.
Brilliant.
Exactly that. And another point to make from an accounts point of view, we see a number of businesses where they might have had profits 3 years ago, but for the past 2 years, there's been losses. And the reason why there've been losses is because there could be, in one particular circumstances, property developers, which we know from time to time, they're putting a lot of cash into the projects. They're not making any money for a number of years until the properties are completed and then sold. So from a point of view like that, John,
Yeah.
would you say that an accountant certificate is more than relevant and should be requested to paint that picture? Because obviously there will be a profit. Well, you'd like to think so, but it could be 2 years down the line. However, from an asset point of view and from a net worth point of view, there's certainly a position. It's just the cash flow is tight because they've got projects ongoing.
No, I agree with that. The other thing accountants do a lot of is something called financial forecasting. So you have property developers, we call kind of like they call long-term contracts, because you're right, you have several years of cost before you make a super profit in a particular year or two. Yeah. Now, people who are doing property development generally have to be careful with their finance, in that actually in order to raise finance, they have to show that ultimately they'll make a profit, right? And we often get asked to create or comment on the financial forecast for these individuals. Yeah. The financial forecast should basically show the costs, detailed costings. So if you've got property developers, again, maybe the tip for them, detailed costings of what this is going to cost, with the ultimate expectation based on the market of what the profit ultimately is going to be, right? And different types of business have different life cycles. So you're right, you'll have 3 or 4 years of losses in a set of accounts. And then in a 4th year, you'll have a load of profit, right? What they may want to do is look at revaluing those assets as they go along, because that'll give you a strong balance sheet, right? And again, as I was saying earlier, the state of the balance sheet is actually the value of the assets these people have access to, right? Think about accountants. So I think Roger alluded to it before. When we're signing off a set of accounts, we have to give or sign off to state that it's a true and fair view. Yeah. Which means that we, in the circumstances, based on the information we have seen, believe that that value is there or thereabouts, right? And it's you need the two statements. You need to know what the income and expenses are. You need to know what the value of the business is. So you need the P&L, you need the balance sheet, and you need the story. And unless you're digging into the story, you don't get the full picture. You might be missing out on business.
No, 100%.
Dan, there's just one point there. I think then for John, Dan, is if you're a mortgage advisor watching this today and you've got a self-employed customer and you want to get the maximum income for them to be able to get the loan size they need, it could be worth then, Dan, doing a joint call between the accountant and the customers, or some form of engagement with the accountant as to quantify how best to position their finances to a lender, Dan. That's the point that's resonating with me, the value of that accountancy within that affordability piece.
No, it's true, and it comes back to what I said at the very beginning. It's all about your third-party relationships and having a good circle of people around you to put you and your clients in the best possible solution. The broker, the glue that sticks everything together in the transaction. And ultimately, whether they do or don't get this mortgage, this property, you're going to get it in the neck, whether it's good or whether it's bad. So having people that you can utilize, or guiding and getting clients ready for a mortgage, whether it's 1-2 years down the line, because a lot of people now spend time getting clients ready, mortgage ready, rather than just churning the business through. So it's just about getting them in the best possible position. It increases your business, but ultimately it gets you a better reputation in the marketplace and more referrals. And that comes on to the subject of second charges. So the second charge market, out of the attendees that are on today, probably only 10% of you will actively do and get involved in second charges. And it's something that's been around for a few years now. They're getting more and more prolific in the marketplace, and they're getting more and more likely to have to be done by yourself, whether it's you're fully involved or you're not involved. But if we look at the second charge market, and again, you guys can chip in if you have any thoughts, but it's a lot more lenient and less restrictive than the first charge marketplace. So if you look at second charge lenders, LTVs are relatively similar to first charge, but you've got the options to utilize income up to 6 times income, which we know on a first charge basis, you're looking at what, 4.5 times at best. So again, bit of food for thought for people. It's not something that's going to go away, but it's something, and it's a tool that you can utilize to get the clients to where they need to be. Obviously, it's not going to work on a purchase because you can't do simultaneous first and second charges. However, if you've got clients that are needing to do home improvements, that were looking at doing a first charge to take out a mortgage that's currently expired, look at a second charge option. If you can't get it all in a first charge, or your rate's really good and you don't want to lose that rate, then look at second charges. You can go up to 6 times income. It's as close to self-cert as we're going to get, because we can use the accounting certificates and projections from an income point of view, which John has kindly mentioned previously. But it's just something that next year that I truly believe is going to blow up, because from Christmas this month, people are going to think, right, I'm fed up of not putting the heating on. It's been freezing the past couple of days. We're going to buy the kids whatever Christmas presents they want. We're going to buy them and get the fattest turkey with all the trimmings and have every single light on in the house and just really enjoy ourselves during this festive period. January comes, people get their credit card bills, and without saying a naughty word, they think, okay, this isn't a good situation. Some people will bury their heads in the sand, so we'll see adverse credit, which we can touch on, and we mentioned at the beginning. But a lot of people will think, right, okay, what can we do? We've got a load of equity in the property. Let's get it against our residential property. They can't get it on first charge because the income's not there because of the way the rates are. So a second charge is certainly an option that people should be exploring and thinking about. And as John mentioned, we can look at using an accounting certificate to get the income to where it needs to be to get that lending, well, all under the roof, really. So second charge, bit of food for thought from my point of view. And Roger, obviously, you guys do a couple of second charges a year, don't you? Not many, but a couple.
Tandem Bank is the UK's largest second charge provider, led by an amazing team, Nigel Brooks and Laura Rebois, Sadie. They're out there active. We don't allow brokers to come direct. They've got to come through master brokers. But Dan, we see it so often. We had a customer the other day with the exact situation that built up a lot of unsecured debt from a family event. They're on a fixed rate. I think it was something like, 1.5%, couple of years to go. And you take out a secured loan, a lot of them have no ERCs. So you could literally have that loan for 18 months, 2 years. When you come off that fixed rate, Dan, you do debt consolidation. Or it could be you're on a really good rate with a lender, but you've picked up a little bit of adverse. You don't want to refinance away because your combined debt would be a much higher rate. Secured loan makes an advantage. But I do think absolutely in January this year, if you're communicating with your customers, it should be, do you need to look at your unsecured debt? And if it's appropriate, is debt consolidation a solution? And hit the obvious question is, if you think you're in a fixed rate, you can't do anything. Well, you can, because even though you're in a fixed rate on your primary first charge debt, that second charge is an option. Now, Crystal are a specialist packager in second charges, Dan. So really, if anybody here has got an inquiry afterwards or wants to come up with some market information to push out to the customers after Christmas, I'm sure Dave and the team there would be able to help some form of overview of how Crystal could give options when it comes to second charge refinancing of unsecured debt.
Yeah, no, absolutely. And it's just about understanding clients' options, because everyone's worked tirelessly to get these clients through the door. And once they're in your shop, you want to be able to sell them everything that came in the shop for a coat. And guess what? You want to sell them the hat, the gloves, the scarf, the shoes, everything that goes with it. So just upskilling what you do is going to be invaluable next year, because again, if you want your income levels to be the same as 2022, because most people have seen a drop in 23, then it's how do you do that? It's all about diversity, and that's what we're going to be pushing massive next year. The sales support that my guys can offer and we can offer as a business to get back to them pre-23 income levels. You're not doing a shed load of PTs, or if you are, you've got a partner, whether it's us or whoever else in the marketplace, that's doing all the other bits of business for you, which ultimately you don't want to do, you can't get involved in, not interested in, or haven't got the experience that you want to delve in that marketplace. So it just comes back to having that wider circle of people around you to be able to help your business grow and just get your income. It's not even about paying for these extra holidays, which is what people used to use us for from a case point of view. Right, we'll place a specialist case because that's going to pay for the Maldives trip. Now it's, we'll place that specialist case because that's going to pay the mortgage. And that's the difference as to what 23 versus 22 is all about. So I think it's just about upskilling. We've been banging the drum, all of us collectively, for years now about the specialist market, and people are starting now to listen, because ultimately they haven't got a choice. It's not as mainstream as it used to be, and ultimately, unless the lenders are starting to nick food off other people's tables from a criteria point of view, the market is going to get more and more specialists. So the information and advice that John's given around extracting income, what to do, getting all the additional documents to support clients is going to be the best bet to get the cases through the door, which historically a lender would have looked at that SA 302 and said, no, we won't do that. So yeah, it's just about explaining the story.
Dan, it leads on to a point though, with consumer duty, guys. If you are looking at a customer who wants to debt consolidate, maybe starting to have some late payments, look at the credit profile, look at the credit report, and see how often they've withdrawn cash advances from the credit card. I saw one recently in the capital taken about £13,500 over the last 3 years on credit cards, and had previously done debt consolidation to consolidate that debt. So you've got to look with your consumer duty lens on this too. If somebody has refinanced once, twice, by capital raising to consolidate unsecured debt and using credit cards to live, there's obviously that real concern of the underlying affordability. So make sure you make the appropriate choices and look at about what is the right outcome, because it's just not an automatic debt consolidation, specifically when people are in effect using monthly withdrawals of cash amounts on a credit card to support affordability. So it's not just lenders will just do it. Lenders now on second charges will push back to be able to really understand that the customer is not putting themselves into a worse position than they are at the moment. So here's a point. And Dan, there's at least 3 new second charge lenders that will enter the market in the first quarter of next year, possibly 4, which will really therefore put some intensity in that marketplace. So some good points being raised. So Dan, have you got anything else, Dan, before I ask you a couple of questions on affordability with buy-to-let, or has John got anything to add on the residential?
Yeah, there's just it's at the other end of the spectrum while we're talking about that. So one issue to be aware of, particularly to be aware of, when looking at a set of accounts, because it can be a little bit false. This can overdrawn directors' loan accounts. So it's not just credit cards, but if people are using their companies as a piggy bank, right? They take cash out of the business, okay? Pay personal debts, live their lifestyle, wherever it is. An overdrawn director's loan account is shown as an asset in a set of company accounts. So it makes the balance sheet look stronger. And the reason it's shown as an asset is that it is a debt owed to the company, right? However, if you take that asset on board, the question then is, if the company is the director's only source of income, and whether or not they can afford to repay that debt. So if you're looking at that set of accounts with an overdrawn loan account, then you may be lending on a false basis. So whenever there's a debtor's note in a set of accounts usually, and if you see a balance that says large other debtor, that's quite frequently worth a question as to whether it's an overdrawn loan account and whether the person who owes that debt is going to be able to repay it.
And that's a great point, that. And Rog, back to the lender point of view, would you guys class that as 100% lending if it's a director's loan that's being used as a deposit or not? Because obviously it has to be paid back. But how would you class that from a lender's point of view?
Yeah, no, it is good. We check to see how, from an account's point of view, if it was a benefit in kind, whether or not interest had to be charged, if it was money that they could rely on, if it was okay. It's commonly used in the buy-to-let world, Dan, as a deposit, where that money is there. They can take that money out. It was their money. It was right. But again, it just needs to be quantified. For a standard high street lender to understand the director's loan for a deposit for a property, and also a solicitor, but particularly an underwriter in the high street lenders, wouldn't really get it. So I think what you would best advise if you go to a high street lender is to get, for instance, a covering email from John as an example, as the accountant, and John to explain that the money that they're extracting was money that they put in, and it's money owed to them. It's non-taxable. They put it in the business no longer needs it because the business has built this, and that money's coming back out. It's just no difference than taking out of a high street bank account in some respects, John. It's sat in the trading account, and they can extract it in certain situations. So if I'd set up a business, I'd put 100 grand of my own cash in to the business. The business now has 2 million in liquidity. There's no negative effect of taking that 100 grand out. These are the sort of questions to ask. But a lot of the guys listening in today, or the experienced guys, either the new to the industry, been in for a while, may never have actually come across the audit trail needed with DLAs with lenders. But yes, we'll be happy. So if we're doing a purchase at the moment, the company has been going for about 18 years. The director is owed the money that they put in. The business is cash rich. We got a covering letter saying there will be no negative impact for that money coming out. There's an audit trail, and it also meets the money laundering regs of where that money was originated from originally when it went in, Dan, because sometimes that can create a problem further down the line. Where did you get the money from in the first place to put in the business? That's not a John question, but it would be your solicitor question as well. But again, it just goes to show the further complexity now when looking at deposits.
Yeah, no, absolutely.
Sorry, it's just kicking in that it's not the situation where they put the money in the first place, Roger. It's where they just borrowed from the company because they think they can.
Right. Sorry. Yes. Bit like bed and breakfasting was the concept. Well, yeah. Yes. Yeah. This is the benefit, though, of having a really good accountant, because you can explain all that and it can be quantified as well. And there's a point of, as you're right, where they've literally just take your money out, it's not theirs. And the bed and breakfasting rule, I believe, is like, it's that 9-month period now where there's that 3 months the money has to be repaid.
And yes, it's owned as a big tax charge, but as I say, it's shown as an asset on the balance sheet, and it may actually be a false asset.
Should we mention what the bed and breakfasting rule is rather than just talking?
Very good point, John. John, do you want to explain it instead of me getting it slightly wrong?
So what you do when you're getting a lot of entrepreneurs, a lot of business owners often treat the company assets as their own, and they're not. And there are various tax rules around that seek to prevent you or dissuade you from taking funds out of your business that you're not going to return or clear by way of a dividend. One of those is if you borrow from your company, and that loan remains outstanding 9 months after your accounting year end, you have to repay, you have to pay the revenue 33.75% of the value of the loan outstanding. And that stays with the revenue until the loan is repaid. So what a lot of people used to do was, just before the 9 months, they'd repay the loan and then they'd borrow it again a month or so later. All right. Now, that doesn't work anymore. That's your bed and breakfast in. So if you repay and re-borrow, then the revenue considered that you haven't repaid at all, and the tax charge is still due.
Right. Okay. Thank you very much for the clarity. Tell you what, either people have left the computer, they're asleep, or the content is just so good today. There's no need for any questions. Speak of the devil. There we go. There's a question coming in. Martin, thank you very much for the first live question. People are awake. So, if the director is just taking money out of an increase in the value of a revalued property as a director's loan, is this income?
Right. So, assuming that's coming from a company, right? No, it's not income. What he's done is he's borrowed from the company, so he still owes that debt to the company. Okay. Whilst the borrowing remains outstanding, unless he's paying interest of at least 2%, which is small, but that's what the current rate of benefit in kind interest is, there is a benefit in kind. So there's a tax charge on that. As I just said, if that loan remains outstanding 9 months after the end of the accounting period, the company has to pay 33.75% of the value of the loan outstanding over to the revenue, which can be repaid if the loan is repaid or written off. At the point the loan is written off, that becomes income, or at the point it's cleared with a dividend, that becomes income. And it's at that point that the individual is taxed.
Right. So and John, we do see a lot of people who indirectly get the wrong advice from their accountancy source and do take money out. We've seen lots of people, John, over the years when we've been, me and Dan have been doing these tax questions on buy-to-let. They've bought a house in Wimbledon for 250 grand. It's now worth 1.1 million. Yeah. And they've got 632 outstanding. The question is, the debt's been rising and they've not accounted for that debt. And at some point, the revenue will find out and make those decisions. So that's why you need to get that good advice. And Dan, it's great to see that Gary is listening. Morning, Gary.
Good morning. Right, we've got 8 minutes left, so that's flown over that session. So should we touch on buy-to-let quickly, and then we'll start wrapping up?
Yeah, let me ask you, Dan. Yeah, let me ask you these questions because you are a buy-to-let specialist and lending in that area. So affordability is an issue now when it comes to buy-to-let, and predominantly there'll be landlords who are coming at the end of 5-year fixes when we had the stability of 299 5-year fixes, and they're now coming into a different rate environment. So what's your view on landlords who are on a high LTV, let's say 75% or above? Their rental income ICR calculator prevents them from being able to refinance to another lender ordinarily. What solutions are you seeing, and how can you help those particular landlords? And what's your view on larger fees but reduced rates?
Well, I mean, what we're seeing and what some solutions landlords are doing is increasing the rent, but that's not a solution, is it? It's just passing the problem down the tracks. But unfortunately, if you're running a business, you're not a charity, are you? Essentially. No. So we are seeing these increases. But if we're not seeing the increases, what we're seeing a lot of people come to us for is being able to top slice or use back income. So that's a massive thing that we're seeing a lot of. Okay, so these the clients can't stay with the same lender. They don't offer PTs. They have to move, otherwise they're going to get killed by the rate that they're just being put onto. The issue that we've got is the rent isn't going to service the loan, because 99% of the time at the higher LTVs, which most landlords are at, they're rarely below the 75%, because a lot of the time, why would you be? We're not on capital. We're putting the 25% in because we wanted that slight bit of capital growth, which they may or may not have seen, but we want to use that as income. So rather than having what 25% LTV and getting income that way. We want to spread it between buy-to-lets. So we've seen a lot of clients come to us where they need to use top slicing and back income, which a lot of people seem surprised about in terms of, well, can that still be done? Who's offering that? There's a number of lenders out there that will still offer the top slicing element and using the back income element, but quite a few of those are packager only, so you have to get access to them via a packager, and that's not me doing a sales pitch. Other packages are available, obviously, but they'll only allow you to access them via that. And again, it's just about understanding the client situation. Do they earn the £50,000 a year or more? If so, and then that picture's painted, then we can draw upon that. And we're seeing a lot of foreign nationals and expats as well that are buying in the UK, but again, they're having to use the back income / top slicing. However, a lot of these lenders in the UK won't use foreign income, where we've got options where they will. And that's the main thing that we're seeing, really. So yeah, it's a case of using that income from a top slicing point of view and backing them and get them where they want to be. In terms of the higher fees, so these 7% fees to get the lower interest rate, it's working. It is working. Do I agree with it? I suppose I'm not going to give my thoughts on that, to be honest. There's a solution there for clients if they need it, but more and more people are going for these higher fee mortgages because they're wanting, and they haven't got an option really. So the backs are kind of against the wall, is what I'm saying on that basis. I think that we should be able to see, and we should see more lenders be able to remortgage these individuals on a like-for-like basis, where they're not having to pass these ICR calculations because it is just a pound for pound remo. I think we could do more in that space. I think you lenders, I mean, I know you don't do buy to let, but lenders could do more in that space to help these essential mortgage prisoners. But yeah, what we're seeing more of, in a nutshell, is back income, top slicing, and then, yeah, unfortunately, these higher percentage fees to get them where they need to be from an interest rate point of view. But I think more can be done in the marketplace to do a pound for pound remo.
Dan, really well put, and again, a great reason for the guys to reach out to you and the team. There's a question coming from Road Topless for you, John, and the question is as following. I'm struggling to understand the director loan and the finer complications, but I did have an inquiry recently from a guy who's taken £215,000 from his business to buy a house at auction, but now wants to refinance by arranging a mortgage to pay the business back. To be fair, not sure where to start with this at all, and it's still still fairly a new advisor. So I think it was, if you could just recover the those 2 points.
So what the guy has done is he's used available cash in his business, right? And because it's in a company, right, it's not his. So he's borrowed from his company as a third-party finance provider. Instead of going to a bank or some other specialist lender, he's basically borrowed from his company, right? The two tax consequences of that are, one, if he's not paid interest to his company, he will have a benefit in kind. And two, if that loan was outstanding 9 months after his company accounts year end, the company will have to pay that charge to 33.75% over. What he's looking to do now, and I see this quite a lot actually, what he's looking to do now is he's trying to take the house he's bought and borrow against the personal asset so he can repay his borrowings to the company because he still owes the company a debt. Yeah. So in terms of the transaction that Ro is looking at, you are looking at whether that individual and the property they have acquired can support the mortgage he's looking to take out. And again, you might want to look at the accounts of his business to see how liquid and how valuable that is in order for him to be able to have the income to repay the personal mortgage.
Thanks, John.
Yeah, no, that's. I'm just trying to think if there's any implications of that. I think it's going to be down to what the property was purchased for, and in what ownership structure as well. Because if it's a case of, if it was a residential property for for argument's sake, purchased it by the business because it wasn't mortgageable, have done some works to it, they're wanting to then refinance it, they're just going to have to be able to prove the trail as to where the money came from and why they're paying it back, because otherwise it would be classed as business purposes on a regulated basis and it wouldn't be allowed. So I think we just need to understand that full transaction and the ownership structure, really. So I think it is relatively straightforward. It's just about understanding it and, again, telling that story, which is the most important thing. From a lender's point of view, because does it make sense? Right, fine. Yeah, we understand it. We understand what the client's done. There we go. We can sort them out. So, yeah, there's obviously a reason for that. And I think we'll start wrapping it up, guys. It's been a relatively interesting session again. So thank you both for joining today. John, as always, you're a fountain of knowledge, hence why we call you the tax wizard. We're going to have to upgrade you from Harry to Dumbledore, to be honest. So yeah, no, thank you very much for coming on. But just before I close it off, guys, do you have any closing remarks, and what are your thoughts on 2024? Rog, if you can go first, please.
My thoughts on 2024, more than ever before, your customers are going to need you and you need to be in front of them. So you need to make sure you've got a digital strategy. So do a newsletter every single month, specifically around when interest rates rise, remain, or fall, what that means to them. Customers who are on 5-year fixes should not be left alone. Someone who's literally, say, 3 years into a deal will be worried about what is the likely fixed rates being available. So it's about having those regular touch points. I know you've got 3 years to go before you're off your fixed rate, but let's set up a call, give you an indication of where rates are now and what that payment shock would mean to you, but what the likelihood of what rates might be in 3 years' time with a guesstimate. Because by getting in front of customers now, it can make them make informed decisions on taking out unsecured payments. The second point is education, education, and education. Make sure that you look at what Tandem's doing in January. We're rerunning our educational slots. They're purely generic. They do not speak about Tandem. It's purely on how to read accounts or how to read bank statements, how to read credit report. And lastly, and most importantly, make sure that you're going to your speed dialing, your phone book, and in your favourites, add Crystal as number one. Because when you get a case, you get a problem, you're unsure, particularly to the newer advisors or the advisors who know what they're doing, then give Crystal a call because they will really help you on. I did a quick interview with Dan. I think it went out last week, Dan, about the Crystal price promise on bridging. And I got inundated with questions about, is it really that good, Dan? So can you just answer to all the people who follow me on social media that is true? And if you've got a price promise or a price match on non-reg, not regulated, I think we have to be careful on reg, but non-reg, it actually does what it says on the tin.
Yeah, compliance will shout at me for mentioning anything regulated. So for compliance purposes, this is non-regulated. But yeah, on bridging finance, which is a massive part of what we do, it's a huge part of our business. And it's a part of the industry that's going to continue to grow, especially with the uncertainty in the marketplace. We're seeing a lot of investors, seasoned investors, purchasing properties via bridging finance to edge the bets as to where the rates are going to go, because everyone's expecting the rates to decrease. It's just a case of when's base rate going to go down, when's swaps going to go down, when's the market going to stabilize. But on bridging finance on a non-regulated basis, we will not be beaten. So by that, I mean, you can go to any provider in the marketplace, whether it's a lender, any of our direct competition, get legitimate terms, and I must stress legitimate terms, send them to me, send them to my team, and ask us to beat the rate, pay you more, be cheeky and ask for both, whatever. As long as you've got legitimate terms, we'll always beat it. It's something that our MD, Joe Breeden, is very passionate about. We can get access to these rates and these deals by our corporate relationships and lenders that we work in partnership. So please, if you do bridging finance, try us out. Let us have a look at it for you. If you don't do bridging, let us do it for you. So just refer it, name, number, email address, and that's it. Or if it's something you want to stay involved in, pass it to us. Clients going to be happier because the rate's going to be better. And guess what? You're going to earn well as well. So yeah, we've got to beat the court service on non-regulated bridging finance. Obviously, try us on regulated bridging. I can't see anything else on that, but you won't be disappointed. But yeah, thanks for that plug, Rog. And John, do you have anything else to say in your thoughts on next year, please?
Next year, 2024 is an election year, and I have absolutely no idea which way it's going to pan out. So I can imagine there's going to be a change in tax policy somewhere. What that looks like, I'm not sure yet, but yeah, maybe a little bit of a roller coaster.
Brilliant. Yeah, and guess what? I imagine as the election's coming closer, there'll be some sort of incentive, like Help to Buy maybe, or something like that. We are needing some sort of help within this sector again, but nothing's going to be introduced until we want that goodwill vote from the public. So I suppose we'll watch this space. But yeah, very much the same for me. I think next year is going to be challenging. It's going to be a tale of two halves. As much as people are predicting base rate is going to drop in Q1 next year, I think it's going to be later in the year. If I'm honest, but they're my personal views. I think it's going to be very specialist. I think it's going to be a lot of adverse credit we're going to see in H1. And we're also going to see the market become more and more specialist. So my advice for everybody on this call is upskill yourself, get to know about specialist finance. If it's not something you want to be involved in, just widen your net, increase your circle of people and allies that you can trust and pass cases across to. But thank you all very much for coming on today, coming on over the past 3 years. We've been doing these sessions now for 3 years, and you know, we've absolutely loved them. We will be back in February for the first one of season 4, which is exciting. There's going to be lots of new content, but very much the same sort of format. And finally, massive thank you and well done for Dave Taylor, our marketing manager, who sits in the background, works tirelessly to get these sessions to be on and to be actually no technical issues. So thank you very much for Dave. You are our unsung hero. But the last thing for me to say is, gents, thank you both very much. Everyone in the audience, thank you very much. It's probably a bit too early to say it, but have a great time off, shall we say. I'm not going to say the C word just yet, but we're getting to that point. So yeah, have a great month. Let's hope we all finish the year strong, and I will catch you all in the new year. Gents, have a great one and speak soon. Over and out. Thank you, guys. Bye.
Bye.